Hey everyone, welcome back to Resonance Spotlight Strategy Notes. I'm Vincent.
And I am Saad.
In theory, equity and credit market are just two ways of pricing the same company. Same balance sheet, same cash flow, same underlying business.
But in practice, they often tell very different stories.
Exactly. And when those stories don't line up, when equity is pricing stress and credit stays calm, or the other way around, that disagreement becomes interesting.
Because for some professional investors, that disagreement is not noise, it's opportunity.
And today, we are talking about capital structure arbitrage, a strategy that sits right at the intersection of equity and credit and tries to profit when markets don't agree with themselves. Let's start very simply. When people hear capital structure arbitrage, it sounds complex. What's the core idea?
At its core, it's very intuitive. The company finances itself through different layers: equity, bonds, loans, sometimes derivatives like credit default swaps. All of these are claims on the same business. If markets were perfectly efficient, those claims would always be priced consistently with each other.
But they are not.
Exactly. Different markets, different investors, different speeds, and sometimes different interpretations of risk.
So, capital structure arbitrage is basically saying if these prices don't make sense together, something's off.
Yes, and the strategy is about identifying where the inconsistency is and positioning for it to correct over time.
Let's make this concrete with a simple example. Imagine a company where the stock market looks nervous. The share price is volatile, implied volatility is high, equity investors are clearly worried.
But at the same time, the credit market is relaxed. Bonds trade tight, credit default swap spreads barely move. Credit investors are saying this company is fine.
Those two views can't both be right.
Exactly. Either equity is overreacting or credit is underpricing risk. Capital structure arbitrage is about expressing that view in a structured, risk controlled way.
Not by betting on the company outright, but by betting on the relationship between those two markets. So, how do practitioners actually express that disagreement?
Typically through relative value trades. So, for example, you might buy protection in credit if credit looks too cheap, and at the same time, short equity if equity looks too optimistic, or vice versa. The exact instrument vary: equities, bonds, CDS, sometimes options, but the idea stays the same.
You're not trying to predict whether markets go up or down.
Right. You're trying to isolate the mispricing. Most strategies aim to hedge out broad market exposure. So returns come from convergence, not direction.
That's a really important point. This isn't about macro calls, it's about internal consistency. So, the obvious question, if this is so logical, why do these opportunities exist at all?
Because equity and credit markets are very different ecosystems, different participants, different mandates, different liquidity profiles. Equity markets tend to react faster to earnings, sentiment, volatility. Credit markets often move slower and are more flow driven.
And sometimes regulation plays a role too.
Exactly. Some investors can only own bonds, others can only trade equities. That segmentation creates friction, and friction creates opportunity.
Let's talk about returns. Where does the money actually come from in capital structure arbitrage?
Primarily from conversions. Over time, prices tend to move toward a more consistent view of the company's risk. There can also be carry, for example, from selling or buying credit protection, but convergence is the core driver.
So patience matters.
This is not a fast trading strategy. It requires discipline and risk management.
Let's be honest though, this is not a free lunch.
Not at all. One big risk is model risk. You're relying on assumptions about how equity and market and credit should relate. If those assumptions are wrong, both sides of the trade can lose at the same time.
And then there is liquidity.
Yes, in stress periods, correlations can spike, liquidity can disappear, and hedges may not behave as expected.
So this is a strategy that rewards sophistication, not shortcuts.
Exactly. It requires strong infrastructure, continuous monitoring, and very careful sizing.
So who typically runs capital structure arbitrage strategies?
Specialist hedge funds, multi-manager platforms or pods, credit-focused teams, investors with access to multiple markets and strong risk systems.
For allocators, what they appear?
Diversification. You're not relying on equity beta or credit beta. You're relying on market inefficiency.
Right, which makes it a very different source of alpha. So the key takeaway from today's strategy note is simple. Markets don't always agree with themselves.
And when they don't, disciplined investors can turn those disagreements into opportunity.
That's it for today's Resonance Spotlight Strategy Notes. Short, focused conversation on how professional investors navigate complex markets.
In the next episode, we'll look at another place where theory and practice quietly diverge.
Thanks for listening and see you next time.